Do you own a business? Have you ever bought equipment, a company vehicle, or even an office building? If you answered yes, then you need to understand depreciation because it's one of the most powerful ways to save money on your taxes. Today, I'll break down in simple terms so that you can help maximize your deductions. So I am Kristen Gunderson. I am the owner of Gunderson CFO and Bookkeeping. And I would love for you to go ahead and like and subscribe and even book a discovery call at the end of this, or there's a link at the bottom. But go ahead and like and subscribe this YouTube channel. That will help with our algorithm. So overall, depreciation will help businesses spread out the cost of large purchases over time and therefore reducing your taxable income. So let's go ahead and dive into this. What exactly is depreciation? Again, depreciation is the process of deducting the cost of an asset over its useful life. It matters because it helps small businesses and large businesses and medium-sized businesses recover the costs for expensive equipment, vehicles, and property. And a common misconception that people have is that depreciation is just a paper loss and that doesn't directly affect your tax savings. Well, that is a lie. Real estate, like if you own real estate properties, that is a huge one where we can have a paper loss on paper, but it also helps reduce your taxes. So there are different types of depreciation methods, and I don't want to totally bore you on this, but most people know of the straight line depreciation, and that is, say, if you buy a vehicle, the useful life of it is for 5 years. And I'm going to go over more of what equipment falls in what useful life category according to the IRS in a little bit. Just give me a little bit of time and I'll get to it in this video. So say you have a car, you would need to depreciate that over 5 years, and say it's $50,000, you depreciate 10,000 each year, and that way you're paying for the whole thing in year one, but you get to depreciate 10,000 in year one, 10,000 in year two, so on and so on until it's fully depreciated. Then there's MACRS. This is Modified Accelerated Cost Recovery System, and this is the most common IRS approved method. It basically accelerates your depreciation. So there's 200 doubling depreciation and there's 150 doubling depreciation. So just know that they exist and that they will help you. Another type of depreciation is there's the Section 179 deduction. And this will allow your business to deduct the full cost of an asset in the year of purchase up to the limit. So there's certain criteria that you have to meet in order to be able to take Section 179. But as long as you have a net profit, you can usually take a Section 179. And again, most of the time it has to be new, but those are all things that when I'm doing your tax return that I would look into and research to make sure that you qualify for Section 179. Okay, there's also something called bonus depreciation. In the year 2024, the bonus depreciation is at 60%. In the prior year was 80%. For 2025, as of right now, in February of 2025, it's going down to 40%. However, we're hoping that with the Trump administration, it will reenact some of this bonus depreciation, maybe bring it up to 100%. So right now it's at 40%. It may change if Congress changes the limits for this year. So this is where, again, we can say you buy a large piece of equipment and you don't qualify for Section 179, we could take bonus depreciation currently up to 40% for 2025 to be able to speed up that depreciation, which when we're speeding up depreciation, we are increasing your costs, which is reducing your net profit and reducing the amount of taxes you will have to pay taxes on because you're paying off of your net profit when you're paying taxes if you have a small business. Okay, and then there's a thing called depletion and amortization. These are just special forms of depreciation for like natural resources and intangible assets. All right. So what are some things that can be depreciated? So there's business equipment like computers, machinery, tools, vehicles. So we have to make sure you're only depreciating the amount of business use. So say you buy a vehicle and you spend 50% on personal, 50% on business, we're only going to be able to depreciate that 50% that you're using for business. And then there's also a lot of IRS limits apply to vehicles. So we also have buildings and real estate improvements. Please note that when you buy a building, we cannot depreciate the land. So we have to take out the value of the land and depreciate only the building. Also, office furniture and fixtures, and then intangible assets like patents, copyrights, goodwill. These will follow the amortization rules. I will note sometimes the question that gets asked is, well, for computers, you can buy a computer for like $600. Would I depreciate that or would I expense it in the current year? What do you think? So the the correct answer is it depends. So the IRS has IRS statute out there that basically they recommend anything that's $2,500 and more, you depreciate. However, so that's kind of my rule of thumb for my clients. If it's like 2 to 3 grand, 2,500, let's go ahead and put that on your balance sheet. So you will not put on your P&L, you put on your balance sheet, and then we're going to depreciate it over the useful life of whatever you bought. However, if you're the owner of your business. If you want to put into your minutes, and again, if you have an LLC, you'll need to be doing annual minutes, but you can go ahead and put into your minutes, you know what, anything, we're going to set a rule that if it's $1,000 or more, we're going to put it as a fixed asset and depreciate it over time. If you buy lots of big expensive equipment, you could like, you know what, I don't want to be 2,500, I want to be 5,000. So but it has to be in your minutes of your LLC stating, hey, starting this date this year, we are going to enact a rule in the firm for our bookkeeping, and anything over X amount, we're going to put as a fixed asset on the balance sheet, and anything under this amount is we're going to expense it in that year. So then again, anything that's under, say, 1,000 or 2,500, whatever that number is that you made up, if it's under $1,000, say $1,000 is the number you made up, we are going to expense it. So I shouldn't see it on the balance sheet. Say that $600 piece of a laptop that you bought, I shouldn't see it under computers and equipment on your balance sheet. We should see it under office equipment under $1,000 on your P&L, and we're going to expense that right away. All right. So I also wanted to go through what are some items and what years they have, because it's kind of helpful to know when you're buying a piece of equipment. Is this a 5-year, a 7-year, 15-year, or on? So for office and business equipment, this is 5 years. So this would include things like computers, printers, office electronics, fax machines if you're still buying them, copiers, a business use of a cell phone. So say you bought, I don't know, a $2,000 cell phone these days, that would be something that we would depreciate over 5 years. Unless you went ahead and made that a lower threshold, like $1,000. And any small tools and equipment. Vehicles, so there's work trucks, there's vans and business cars. Those have to be for business use only, and then those will be a 5-year. And then just so you know, there's limits that apply to passenger vehicles. So luxury autos, there's depreciation caps that apply. So just so you know, then that's all stuff like, for instance, I had a client buy a truck. Well, I need to know, how much does it weigh, and is it a 6-foot bed? Well, it was under a 6-foot bed, so it had different limits than a bed that was 6 foot or longer. So those are all things that we need to look at when you are buying assets. There's items under 7 years. So 7 years is like heavy equipment, heavy machinery and equipment. So these are things like your construction equipment, like excavators, forklifts, bulldozers. We also have machinery, manufacturing equipment, farm machinery like tractors and harvesters. And then there's the other things like that you would find in an office, like your office furniture and fixtures. So those would be like desks and chairs, file cabinets, conference tables, shelving units, and retail display cases. This all falls under 7 years that you have to depreciate it. All right, now we're getting to 15 years. What comes in under 15 years that we have to depreciate? These are your leasehold improvements. So these are your renovations to leased office spaces. We have installing walls, partitions, or flooring, and any built-in fixtures like your lighting and plumbing. This would all fall under 15 years. And then we also have land improvements. Land improvements are also for 15 years. So this includes landscaping, fencing, parking lots, outdoor lighting, sidewalks, and irrigation systems. Just remember, the land itself does not get depreciated. We have to take that out. That does not get depreciated at all. It's these land improvements that get depreciated. We also have some more items that fall under 15 years. Usually these are intangible assets, and this does vary, but the typical is 15 years. So these would be your things like your patents, your copyrights, your trademarks. Those all get amortized over 15 years. Then we also have goodwill. So this is if you acquired or purchased a building, purchased a business. You would have goodwill in there. So then we would need to go ahead and amortize that. And then there's also franchise agreements. So whatever the agreement is in the franchise, that's what we would have to amortize that agreement over the life of the franchise agreement. Now there's 27 and a half years. What falls under 27 and a half years? This is your residential rental property. So these are your rental homes, apartment buildings, and depreciation applies to the structure only. Again, not the land. We have to take the land out of it. That doesn't get depreciated. And then if you have any improvements to the rental property, like a new roof, HVAC, plumbing, those are depreciated separately. And then the last item we have on here is 39 years. 39 years we have to depreciate, and it's commercial buildings. So this is your office buildings, your warehouses, your retail stores. Again, only the structure is actually depreciated, not the land. And then lastly, what if you're in the farming, like the livestock and agriculture? So if this is you, like your cattle and horses will be depreciated over 5 years. If you have like hogs and sheep, that's 3 years. And then your farm buildings are 20 years. I want to take you through a real life example real quick. So basically, say you're in the printing industry and you go ahead and purchase a piece of equipment that costs $50,000. So we're going to go ahead and compare the different depreciation methods. Say this was a 5-year depreciation. If we were to use a straight line depreciation, that would be $10,000 we're able to deduct each year to spread out the cost of that. If we have a profit in the business and it's a new piece of equipment, we might be able to get Section 179, and then we could take the full $50,000 in 1 year, and it's, again, if it's eligible. And then say you bought this in 2024, right? We're gonna try to do the bonus depreciation. It was at 60%. So if we're able to do that, we'd be able to depreciate $30,000 in 1 year, with the rest being depreciated over the remaining 4 years. So those are just different examples of what we can do if you bought a $50,000 piece of equipment and it was in a 5-year category. Okay, what are some common mistakes and how to avoid them? The number one common mistake is not claiming depreciation at all. So like basically you're losing that tax savings. Like you completely forgot. You only looked at the P&L, you did your own tax return, you put in all the income and then the expenses, but you forgot that you bought a piece of equipment that was worth $20,000 and you bought it like 2 or 3 years ago and you haven't been depreciating it all this year. You are losing out on that expense that will reduce your income, which will reduce your taxes. Another thing that you could do wrong is you could misclassify the assets. Say you have a commercial real estate. Instead of depreciating over 39 years, you thought it was the 27 and a half, and you've been depreciating it for 27 and a half years. So you're speeding up that depreciation, but you're taking it wrong. If you get audited, you're gonna like they're gonna have to go back and correct it all, and you had more expenses now than you should have had. So then that will make your expenses less, which will make your net profit more, and then you owe all those back taxes. Like you say, you should have paid in a little bit more each year, and then you have to pay the taxes on that, any penalties and interest that the IRS may decide to impose on you. Another thing is people forget about is depreciation recapture when they go ahead and sell that asset. Sometimes, like say, this happened a lot like in I think 2020 and 21 when we had 100% bonus depreciation and people were buying their vehicles and depreciating the whole thing. Do you remember when that was happening? Well, then like a year or two later, they would go ahead and sell it. Well, guess what? You bought an $80,000 car, you depreciated the whole thing or truck, and it was worth, say, $60,000 when you traded it in for a newer model truck. So now, and say that was it. You had $80,000 truck you wrote off the first year, you kept it for 2 years. Now it was worth 60,000 when you traded in. But on paper, it's worth zero, but you just had a $60,000 gain, capital gain that you're gonna have to pay taxes on. Yeah, we can buy a new vehicle and depreciate. But remember, the bonus depreciation has been going down. So say the truck's worth 100,000 now, but you can only write off 40,000 of it. There's still between the 60,000 gain and the 40,000 writing off, like you're still having to pay taxes. So that's sometimes um people forget about that. Or if you like say if you just sold it outright, like say you had that rental property and you've been depreciating it, depreciating. Well, say you've had it a really long time, like instead of say you've had it for 30 years now, and so it's been fully depreciated because that's 27 and a half years you can depreciate it. It's fully depreciated now. But remember, real estate values go up. So say you bought it for 100,000, it's completely zero on paper now because you've depreciated the whole thing. But say you sell it for what, 200,000 now or 300,000, the difference between what you bought it for, say you sold it for 300,000. It's been a long time you've had it. You bought it for 100,000, maybe have 50,000 worth of upgrades in it. So say at 150 minus 300,000, you still have 150,000 worth of capital gains you're going to have to pay taxes on. Another mistake that you can make is not working with a tax advisor. We can literally talk you through these things with your specific situation. And if we know about it in the year that it's happening, we can help you navigate paying those gains. Like if you sold that piece of property, I would recommend maybe doing a 1031 exchange, like, you know, buying another piece of property and putting it in there, and that way you don't have to pay those capital gains. Or if you don't want to do that, like say you want to have the cash, maybe there's oil and gas that we can invest in with those profits that will offset the capital gains. So there's things that we can do if you're working with a tax advisor to be able to minimize those mistakes instead of just being blindsided and now the tax is due and there's nothing you can do about it. After the facts tax preparation, like if you're coming to me now in February to do your 2024's taxes and this is something that happened to you, there's nothing we can do about it. Absolutely nothing we can do about it because we're being reactive. If you want to work with a tax advisor, aka us, we can be proactive about it, but we'd have to know about it last year and start working with it and figure out what to do to help you overcome that. Depreciation is a key tax strategy that helps reduce your taxable income. I really encourage y'all to check with your tax professionals and make sure that they are maximizing your deductions for you. And if you need a new tax preparer, we don't accept new tax clients unless you're an tax advising client. And then we'll go ahead and prepare your taxes for you. But those are the clients that we are accepting, is we're accepting new tax advising clients. Um, we would love to have you go ahead and book a call with us, book a discovery call, get some of your questions answered. What does it look like to work with us? But ultimately, go ahead and subscribe to our YouTube channel, like the video, go ahead and comment on it. We would love to have your comments and share this out if it was helpful. Thank you.